is Sky News Real Estate. Smart investing.
Hello and welcome to Smart Investing. I'm Chris Gray. On tonight's show, what is debt recycling and how can it help you as a homeowner or an investor? How can your living expenses affect your borrowing capacity? And what has been the fallout from the Banking Royal Commission? Well, joining us tonight is John Mansamelli from Hunterwood Solutions Mortgage Brokers and Charles Tarbey, Chairman and owner of Century 21 Australasia. Well, welcome to the show, guys. Debt recycling, something new to me. What does that all mean?
It's about grabbing all the income and equity and working in a way where you can redirect all of your income into your home loan. And so if you're in a position where you've got a bit of equity in your investment property and you've got a bit of rental income, it's redirecting everything into the offset account or everything into the home loan. So it's an old strategy that everyone seems to have forgotten about, but it's something I want to reinvigorate because it's had a dramatic effect on a lot of my clients, and I think it might be a really good time to bring it up, given this is a good quality investment property show.
Now, Charles, whenever people think of these various different things, and I'm sure it comes and goes over the times, it's right to get the right advice, isn't it? Because you go off and do something by yourself when it comes to a mortgage, and the tax consequences, if you get it wrong, could be dramatic.
Quite dramatic, particularly when some people try to align investment loans and their own home loan, and sometimes they cross the two over and find themselves with a tax issue, a tax problem. Consolidating debt or debt recycling is a fantastic way that, as John said, has been forgotten because if people just buy things and progressively over a period of time they've got maybe a new car or a boat or some furniture, fixtures, fittings, and they're paying a higher interest rate on that than they're going to be paying on something else, and consolidating that debt into their home loan, particularly now because there's so much more equity being gained by anybody who bought real estate 6 or 7 years ago in most of the country. They've got all this equity and they're not using it. They're paying 2 and 3 times the interest rate that they might be paying on something else.
So, John, what are the...
Is that what you mean? Sorry, John? Is that what you're talking
I gather
about?
there's a couple of ways to do it as well, isn't there?
Yeah, so there's 2 ways you can do it. The first way is to redirect all your rental income into your home and your PAYG income. And the idea is that you have a line of credit attached to your investment property and you're drawing your line of credit up, and that's being used to help pay the investment property. And at the same time, your owner-occupied debt's coming down because you've got all of your rental income, PAYG income going into your home loan. So that's a cash flow technique. Now, the second part is under what's called a master limit product. We have, say, $2 million and you have a number of home loans, and you can move the debts around so that you can remove the debt off your owner-occupied home loan and then move it onto your investment property debt. And as you correctly mentioned, you want to be careful that you don't claim that debt if you move it off your owner-occupied and put it onto your investment property debt.
And I think we've got an image that we can pull up. Actually, we've actually got it on the screen there.
On the top left-hand corner is your principal place of residence, and you can see your wages going into your home loan. And the bottom left-hand corner is your investment property with the rent. You're putting it all into your home loan. Now, on the right-hand side, on the top right-hand side, you can see that you've set up a line of credit, and you draw that up, and you use that money to help pay the investment home loan. So your owner-occupied debt's going down, and your line of credit or some sort of credit facility is going up in value, in debt, sorry. So there's quite a tremendous opportunity there to improve the cash flow. Improve the cash flow between all the various rents and equities that you've got there. So that's called debt recycling.
And hopefully we've got all that, just having a bit of fun with the microphones as usual.
I don't know what you're talking about.
So, Charles, I guess...
Just watching John keep a straight face while he's being tampered with.
That's it.
I guess, who are the important people on your team? So we're just talking about a mortgage broker here coming up with a new idea. What other kind of people should you be checking in with during the year? Well,
as I was saying before, I think that there's a bigger picture for most people than just moving their money around. And you talk about your PAYG, everything going onto that home loan. And that is a technique that I'd forgotten myself. People were using quite strongly, and banks weren't very happy about that process. But there's a significant amount of debt right around everybody's lives, and most of my team are now looking for ways. And there's a lot of people refinancing now because they're coming out of fixed loans, or there are people who have got variable loans that they could change. There are banks now competing. There's a whole range of issues, and I don't even think I'm answering the question you asked me, but that's what I'm going to tell you anyway. How's that sound?
Exactly.
I'll answer it.
Again, So accountants, financial planners,
Yes.
all good part of the team?
Well, very much a part of the team, and I think that not only financial planners and accountants, but it's important that you look around the industry. We talk about brokers being a very big part of it. I think they still very much are, because they're going to find that right competition for you. I also think you go back to your real estate practitioner, because sometimes you just don't know what value you have in your properties, and you can make an assumption on that when you have a significant amount, and instead of calling in a valuer early stages and paying for that, you're probably better off finding out just roughly what your property's worth. Then you maybe go to another level, and you might even find yourself in a position where you can buy another property, which would be nice too, particularly in today's market where prices are moving downwards.
So John, can you actually capitalise the interest in the line of credit?
Can you capitalise the interest? It depends on the home loan product that you've got, Chris. So not all lenders will allow you to use the equity you've got with the line of credit and not make any repayments. So some lenders will allow you to have a line of credit and increase the debt without having to make any repayments. So it depends on the home loan product. And this debt recycling product is not very well known by mortgage brokers. In fact, I'd say in the top 5% of mortgage brokers who would know this product and therefore know which lenders have that. And given this is an investment property show, I'd encourage you to find those brokers that specialise in investment property.
And again,
really
that's our classic thing, is no matter what people you've got on your team say, are you investing in property yourself? How many property investing your clients have you got? Because they're more likely to know what's going on than if they're just someone that's just got in the industry and are just dealing with first home buyers.
You know, look, Australians have amassed quite a lot of wealth in their property, and if you're presenting with 2 or 3 properties under your belt, particularly on the eastern seaboard, this debt recycling product is an amazing way to reduce your term on your owner-occupied home loan.
John,
incredible opportunity.
Let me ask you this question though. If you looked at rental return, for example, I'm going to create mayhem for real estate practitioners right now, but let's just say...
You're good at doing that, Charles.
He's very good at that. Like, he's a master at it.
Let's just say that a person has their rent paid to them into their loan account on a weekly basis rather than a monthly rental return. What's the difference?
Oh, massive. And if you could get it paid daily.
There you go. We just...
All your Century 21 branches are going to be ringing up saying, Charles, you've given us a nightmare.
Stop getting on
you know
the
what?
show.
If you offer... It's all about offering a service, isn't it, to clients?
But that should be automatic these days, shouldn't it, with computer systems?
Today, yes. Today it can be done. That's why I was just thinking about it with different payment systems. But the biggest issue is the payment platform and the cost of each payment that's made. So if you can find a provider that won't charge you as much for every transaction that occurs, then you've got a fighting chance to make that happen, because you've got to on-charge that too. So if you're on-charging these payment fees to banks and etc. for each time they make a transfer, it could become negative for the landlord. Yeah. So you've just got to find a way of getting it done where the cost is efficient.
Modest.
But certainly there's nothing stopping it from happening automatically.
Yeah.
Nothing at all.
Now, we're going to Charles's numbers and auction clearance rates in a second, but one thing you mentioned before that was about that parts of Australia have obviously kind of come down in value. A lot of, I guess, typical investors and homeowners will think that's a negative. But to a lot of people, it should be a positive, shouldn't it?
Buying opportunity, yeah.
Because they've been whinging for 3 or 4 years that the market's too hot. Now it's come off. They're still whinging, oh, it's going down
there
now.
We go. Oh, better stay out of it.
And then it'll be going up again.
Yeah, yeah. So, you know, if you've got a 2030 strategy, history's on your side. So, you know, take advantage while you can.
Charles, take us away with the clearance numbers.
Really interesting numbers again. They're sort of slowly declining each week. Not massively, but 61%. That to me is still not a bad figure, 61% from a clearance rate perspective, but still at the end of the day, if you look at where it was this time last year, it was 72.8% this time last year. So that's a pretty big difference. The best marketplace is actually, again, not Sydney and Canberra. Go figure. I'm sorry, not Sydney and Melbourne. Canberra was the one. 77.1% clearance rate. It was the only capital city that was better than this time last year. The only one. Melbourne had 1,090 auctions. They had a clearance rate of 61.2%. And Sydney had 767 auctions at 62.5% clearance rate. So it's a pretty tough market. A lot of agents are finding it difficult out there because they're accustomed to things happening quickly. They're out there grabbing as many listings as they can because that's what was happening, but now they're grabbing a lot of problems because they've got to go back to their sellers on a weekly basis and say, I don't have anybody for your property. So there's a whole new level of education going on out there.
And especially for those agents that have gone into the market in the last 2 or 3 years, it's suddenly a rude awakening.
I've got to stop talking about that, but it's true. But those that haven't been trained on actually understanding the process of a transaction, negotiating a transaction, you know, the private sales or the upfront commissions, all those things, they're all great. But the reality is you need a good real estate agent who can put together a buyer and a seller for the benefit of both parties.
And that's the market. That's the normal market. It goes in cycles. So the real estate job could be 2 or 3 sets of jobs depending on what,
Correct.
where you are in the cycle.
A short period of time. The one that we just had went a little bit longer. We're in real estate now. Real estate is finding somebody who'd like to pay the price a seller wants for their market.
Sounds good. Well, how many properties are coming up for advertised for sale?
More. We had a few weeks to decline, and usually into winter time we do have a bit of a decline, but we had a 0.52% increase in stock, and that's 6.38% more than this time last year. So it's still a lot more stock. Again, you were talking about it earlier, about a good time right now. So a lot more stock, a lot lower clearance rates, a lot fewer buyers out there, a lot more restrictions on lending. You know, that's all going to take us to a certain place.
Yep. And how about the vacancy rates? Because, again, I've just come back from Asia, and I'm not sure if I mentioned when I came back from Malaysia 3 weeks ago, they were talking about 45% vacancy rates. So they think of Perth, 9%, that's nothing.
I know, it's nothing. But the rental movement, let me just cover off on the rental movement first, because that was a plus 3.23% over this time last week. But Adelaide's declining in its rental return, which is one we were concerned. Sorry, I'm really confused tonight, John. I don't know what it is. Hobart is still declining. That's what I'm talking about, because there's a lot of investment properties coming up there now that won't be rented. But overall, it's a pretty steady marketplace with a rental return. Nothing fantastic at all. But vacancy rates.
So I've been playing around. Sorry, I was on a different planet. I was 5 minutes ahead of you.
I thought it was just
Let's
me
talk
tonight.
about vacancy.
I thought it was just me tonight.
That's all right.
Vacancy rates. You were about Perth, 9.68%. Man, we were over 10, 11s, and it went down to 7s. It's now back to 9.68, which isn't a good thing. Melbourne, astonishing 0.54%. Sydney, sitting at 2.63% vacancy rate. So, over the 4s, 4.28 vacancy rate for those 3 capital cities. But we need to watch Perth very closely again.
Now, John, obviously there's a lot going on in the market. You've been very much a fan. You've been an investor for a long time.
Yep.
And I know you've been following the country. So you were up in Brisbane years and years ago. You've been down in Canberra.
Yeah.
You really do get on the ground and investigate those markets at the right time. So you're not listening to the papers to see when it's... You're trying to look before time, aren't you?
Yeah, I mean, I'm listening to Charles and I'm going, Perth, it's a buyer's market. Wow, that's awesome. Now,
and you're right, yeah, Perth, you get to Perth because the prices, we've talked about this before, the boom started years ago. Perth prices almost got to Sydney prices at one stage before Sydney jumped.
Yeah.
And then Sydney jumped and Perth went backwards, back to where it was pre-boom. So people are selling properties now for less than what they bought them for.
And
go back 6, 7 years.
The biggest transfers of wealth always happen when everyone thinks
and
the world's
the
going to
economy there is far more stable and mining is stable, so it's all settled in.
So, time to be contrarian.
Sorry, you've got to kick us out now.
Time to be contrarian. Anyway, we're going to take a short break, but we'll be back soon. Stay with us.
You're watching Sky News Real Estate. Smart investing.